Hi, I'm Helena, Pozniak, finance journalist, and I'm delighted to be your host today for this Beyond Property Masterclass webinar, a Telegraph Media Group hosted event for Netwealth. Please note that this event and the discussion today are for information purposes only and do not constitute personal financial advice. We'll be discussing why Brits love to invest in bricks and mortar and how their relationship with property may be changing. We'll also talk about how property measures up against other financial assets, depending on your goals, your stage of life, and your plans for the future. And with me today are Mackay and Matt Conradi. Holly has 25 years' experience in financial services and is the founder and chief executive of Boring Money, a free, independent website that offers consumers help with investments and pensions. And Matt is head of client advisory at Netwealth. He's worked over the past 15 years with clients and families to build their financial plans and manage their investments. So a question to you both. Why do you think we've been so keen on investing in property in the UK?
I think what we find in the UK is that people are quite risk averse and they think they understand property. There's all these sort of phrases that come along, safe as houses, English as a man's home as his castle, and that makes them think about property as a first starting point for them. So we want to get on the property ladder, and then we think we understand that more than perhaps investments, because those can be quite opaque to an individual who's just starting out. And we also look at what's happened over the last few decades, and people see that house prices have gone up and they feel that as a tangible thing. So it's often the first port of call for people.
I definitely think trust as well is a key issue. The financial services industry isn't really trusted still. And with a property, you can see it, you can touch it, and there's none of this sort of jargon surrounding it that we have with investments. So I think trust is a sort of really key part of why people like property, because you can see it, you can touch it.
How are things changing now for private landlords? What's on the horizon for them?
We've had loads of changes to the landscape from a tax perspective over the last few years that I think have really changed the thinking for a lot of people that are already invested in properties. We've had a higher rate of capital gains tax. So if the property value increases, the tax you pay when you take that money out. There's higher stamp duty as well for second homes in particular that's come along. But also a technical one, but really quite relevant, is if you're borrowing money to invest in that property with a mortgage, the way you can deduct the interest cost has changed, and that really changes the sort of net return for investors now, particularly if you're a higher rate taxpayer, because there's now something called mortgage interest relief, which only goes up to the basic rates. It's 20% relief, and that can really change the dynamic of whether it's a good investment or not. So I think that plus some of the other changes that are coming around for renters as well really has sort of made people think twice about whether it's as attractive an investment as it perhaps was.
Do you think people believe property's less risky on the whole than stocks and shares?
I think from my experience, yes, talking to individuals, because of that trust element, because they understand it, they can see it, they feel that it is less risky. I think your average investor isn't very good at assessing risk as well. And what do we mean by risk? So in the investment industry, we talk about risk often by volatility, things going up and down and drawdowns. The great thing about a house is you don't value it every day. So you don't think about what it's worth. But if you had to get a price for your buy-to-let flat or your own home for sale this afternoon, it's not going to be anything like what you think it's worth, because that's what you're doing with an investment. Every day, someone's saying, this is what it's worth right now. This is what I'll pay you for it right this second. And so people don't necessarily assess the fluctuations that happen. So that's sort of illiquidity risk essentially that's in there. And I think people also don't think about some of the other elements that come from the risk, which is things like if you're renting it, what's the void risk? So that's the idea that you go a month, 2 months between tenants. And what does that do to your total return? Because unless you're putting it all into a spreadsheet and calculating it, you're not thinking about those things. Whereas a financial asset, you often get a valuation, you can log on and see how it's moved day by day. So I think that risk is definitely something that people feel more tangibly with those types of investments. And then it goes back to looking at historic experience. They think that the returns have outweighed that risk, and that might well be true. But some of that is because you're being compensated for those risks over time, and the industry does tend to do that. If you invest in a liquid asset, there is a premium to be had. You just need to be aware of whether that is a risk for you. And some of this comes down to the stage of life you're in and your goals as to whether that is a risk or not.
Holly, are we getting our risk wrong?
I think people tend to consistently overestimate the risk associated with investing in stocks and shares. We know that particularly for people that are starting out, they haven't invested yet, there's always this sort of lingering sense of dread, because you tend to hear about stocks and shares in the news when it all goes horribly wrong. You tend to hear less about it when things are sort of ticking up and doing well. So we know that particularly for less confident investors, they do overestimate the risks of investing in property. I'll also say, until about 3 or 4 years ago, I had a buy-to-let property. I bought it when I sold my first business. I sold it because actually it just became more and more expensive to be a landlord. It became a lot harder. So we've got to take into account also the time and the hassle factor of running property. It's not an easy thing to do, even if you have an agent sort of managing it for you. So I think we consistently, I would say, underestimate the risks. Matt talked about sort of void. I remember renegotiating rents, and I made a mistake once. I was too greedy. And I went, oh no, I want to hold out for a higher rent. And it sat empty for 2 months. That was a really dumb move on my part. So I think there are more hidden risks with property than we perhaps realise.
And it's interesting you mentioned the hassle factor. I know, Matt, you've talked about this when you're in a certain stage of life, you don't want to be worrying about your property. So.
Yeah, absolutely. So I think if it all goes well, you buy your property, it's rented out and you don't have to think about it. But it's the reality is that you've got one property, and if one thing goes wrong with that, that has an impact. And that comes at 8 p.m. on a Sunday when the boiler breaks and you're the landlord and you need to help fix that, right? And that's part of the reason why you get a higher return for it potentially over time. And I think it's those elements that people don't always factor in. Then you do sometimes overestimate it. You hear the horror story where someone hasn't left the property and they've had to take them to court to take them out. Now, that doesn't happen all the time either, but part of this is about diversification. If you've only got one property, the risk is that might happen to you. If you're a buy-to-let landlord and you've got 50 or 100 properties, then you're sort of diversifying some of those risks. But most people can't afford to do that because the unit size of a property in the UK is large. Whereas a stocks and share, you can do some of those diversifying elements because you might be able to buy it for £1 or buy sub-units in a fund or so on. Whereas I think those are the big things that aren't thought about. The other bit that comes around over time, I think, is just thinking about the emotional impacts of this. And for you, as your goals change and your impacts and your objectives change, it might be really sensible for you to have a property when you can sort of leave it alone and not think about it and it's just for growth. If you're trying to use that to help support other objectives, properties again become a little bit harder to move around, to take parts of them as well, and to help you think about different parts of your goals.
So what does it mean to be truly diversified? How do you work with your clients at Netwealth to achieve this?
Well, so yeah, diversification actually is a really important factor of investing, and virtually every professional investor or investor will talk about it. And this is this idea that you don't have too many eggs in one basket. That's the sort of simple example that we all know and understand. But that isn't always understood in terms of how you actually put that into a portfolio. So you might, if you're thinking about individual stocks, we often say 30 stocks gives you diversification. So if you have 30 stocks in a portfolio, you're not going to be overly exposed to any one company. And an example I sometimes use is with BP. There was the Macondo oil disaster. That was a really specific thing that happened to BP, and it really impacted BP's share price. That isn't the financial crash or impacting all shares at the same time. That's a stock-specific part. So if you have 30 stocks, that's not going to have too much of an impact. But sometimes people think about diversification wrongly. So they might say, I've got one FTSE 100 tracker and another FTSE 100 tracker. Well, just because there's two funds, but they track the same things, that's not diversification. As you start to build up more of a portfolio, you're looking for things that move in different directions at different times. So it might be that you've got some stocks and then you might have some bonds. And when stocks go down, sometimes bonds go up. or it could be currencies. So we think about things like having the Japanese yen in a portfolio. Now, these are getting more and more complex elements of diversification that you might need a professional manager to help you think about. But the broad concept of having not all of your eggs in one basket is a sensible thing to apply to it. So that is having some property maybe. But remember, you've got your own property often. So you might have a large proportion of your wealth already in UK residential property. And what we so often see is, for the convenience factor, someone buys a flat near to their house. So they've got no diversification. They've got a second property in the same postcode as where they already are. So if that postcode doesn't go up or there's a problem, it's more likely to impact that second property as well. So if you are going to be thinking about property, try to get some level of diversification, as in something in a different place that might move in a different direction over time.
I think the other thing to add is diversification can be achieved really quite simply. These days, we have things called exchange-traded funds. That means you can buy one thing, you can buy it in a stocks and shares ISA. If you're tracking, for example, something called a global index, you buy one thing, but you get about 1,300 companies inside that one thing. I think of it a bit like a playlist, if you will. So it's quite easy these days to get, as Matt said, access to a really broad range of things without having to buy lots and lots of sort of products and do tons of research as well. So it is simpler than it's ever been to diversify. I think that is a really key point about property. For most of us, we'll only be able to afford, if we can, one buy-to-let property. And as Matt says, and I have some experience of that, if it's empty for some period of time or you have problems with a tenant, your eggs are in that one basket. So I think that's quite difficult.
Perhaps we could talk about the different life stages people might be at as well. So the accumulation stage, when you approach retirement, once you've retired, and draw down, and also passing wealth on. And during these different stages, where should people put their money?
Well, if we start with accumulation, the great thing there is you've got time. Mm-hmm. So you can afford perhaps to have that illiquidity, that idea that you can't sell something over time because you're investing for a long period of time. What you get there is the benefit of compounding as well. So if I'm thinking about property versus investments, let's say, you want to invest, start with, don't sit in cash. Let's take some risk. Let's get some investments that might grow through time and compound that return. If I think about property, the plus at that moment is maybe that you can borrow money against it. If you think about your property, it's the easiest place to borrow money at the lowest cost, essentially. That might be a mortgage on your own home, which often is what people are doing, or it might be a buy-to-let mortgage on top of that. And that gives you what's called leverage. So that means that if the return of the property goes up, your mortgage stays fixed, but the bit that you own keeps growing. So you get an extra benefit from that. So that can be really helpful when you're in the accumulation phase. You can take the benefit of leverage over time on the upside. But the same is true for investing in other parts of the market. You don't get leverage, but things like pensions give you tax relief. And that can be really powerful. So if you get essentially your income tax back on the contribution you put into a pension, and then you can compound up that part, the additional tax benefit over time, that's really, really great thing to have. And money in, say, pensions and ISAs is tax-free as well. So in that accumulation phase, it's about saving as much as you can, benefiting from that growth through time. And property can definitely be a more relevant factor. I think the other thing in accumulation is your own property and whether you're paying down some of your debt on your mortgage as well is a particular factor that we see people sort of trying to work through.
And I think as well, it depends, doesn't it, if that property, is it a home or is it an investment? And so I think those are two really, really different things. Are you buying a house for somewhere to live? Are you buying that flat because it's your main sort of family home? There'll be really different, more emotional considerations then, as opposed to simply a buy-to-let from an investment perspective. Another factor is for any listeners lucky enough to be under the age of 40, there is something called a lifetime ISA. You can put in up to £4,000 a year and the government will contribute up to £1,000 a year into that towards a first flat or a property. So that's certainly something. It's one of the ISA sort of family, if you like. It's something worth considering. But I think there are different considerations depending on whether it's somewhere we're planning to buy to live or somewhere we're planning to buy as an investment. And I'd approach those two really quite differently.
We often find in that early accumulation phase, you start off with liquid investments. So you're saving towards that first deposit for the first property. And then all of your wealth sort of plunges into that property, which is a natural thing to do. And then you start to diversify. You might add in the LISA, the pension contributions, and you're trying to build up, again, back to diversification, a mixture of different pots of capital over time. And maybe a buy-to-let is another one of those things to add into that mix. But it doesn't have to be a trade-off. It's not an all or nothing, one or the other, to think about. It's about balancing the benefits of these different pots. Some of that is about time as well. So if you put money in a pension, you can't access it until you're 55, and that's increasing to 57 over time. So you've got to bear that in mind versus something like the LISA, which is great because if you really need to get it, you can take the money out, but you should be leaving it for the long run to get the benefit of the actual tax benefit that you get from the government.
How do you work with clients at Netwealth to make them aware of tax efficiency and
It's a really important factor. So we often talk about controlling the controllables. So there's a whole bunch of things that we can't control. How markets will go up and down. I can't control what Donald Trump will say in his next tweet or so on. Sadly not. But we can prepare for some of those things through diversification, and tax efficiency is a big part of that. So if we're controlling the things we can, making sure you do the sensible things on tax is really important. So that might be using your ISA, using your LISA, thinking about your pension contributions. So for example, if someone is at the point where they're earning 100,000, a little bit more than that, they start to lose their personal allowance from a tax perspective. So we'll talk to clients about maybe making a bigger pension contribution to get that benefit back. Now, if you happen to be a young parent as well at that same moment, you'll also you might have lost some of your free childcare. And so if you think about a pension contribution at that moment that brings you down below 100,000 of taxable income, you get back your personal allowance and you get free childcare. That's a huge benefit that you can control. And that has nothing to do with what's going on in the world, what inflation is, what interest rates are doing. So we focus on those elements. The other things you can control that sit alongside that, things like fees and the costs of doing things. So that might be fees when you're buying property, what you're paying to your agents and so on along the way, or fees for investments. And Holly talked about ETFs. They're great because they're low-cost ways to get exposure to markets. We really try to help people think about those parts of it. So it's diversification, tax efficiency, and then fees as well. And if you get those bits right, you're going to be much more likely to achieve your goals than worrying about too much around the market moves and the things that you can't control.
Do you think we're tax aware enough, Holly?
No, and I think this is something around pensions, I think, is the key benefit of a pension is poorly understood because people talk about tax relief and not everyone knows what we're talking about. So let's give an example. If you put £8,000 into a pension and you're a basic rate taxpayer, that automatically becomes £10,000 because effectively you're getting a refund from the government on tax you've already paid on your income. That's astonishing, and I don't think that's communicated well enough by the pension industry. Where else can you put £8,000 into an account and it immediately becomes £10,000? Then, as Matt said, what's happening to that is hopefully you're expecting stock market growth over time to slowly increase. It's like building a snowman, to slowly increase the size of that snowball. And the bigger it gets, the quicker it gets bigger, if that makes sense. So this is the sort of power of compounding. So that is a really key advantage of pensions. Now, if you're a higher rate taxpayer, you get even more tax relief back. When you file your tax return, you can claim back the extra sort of higher rate tax that you've paid already. So I think that's not spelt out enough in sort of pounds and pence to people. It's a really key advantage of pensions that still isn't fully understood, I don't think.
Sticking with tax, actually, I wondered if we could talk about if we are deciding to possibly shed our property investments, how do we deal with capital gains tax?
Yeah, it's a really good question, and it's often something that keeps people locked into their existing investments. So they're worried about paying the capital gains tax and the impact that has on day one, because it is a bit, in a way, like the pension contribution. You think you've got the 10,000 and then you have to pay the tax and it becomes a smaller number. So it feels sort of painful to do it. There's not a great deal you can do from a second property perspective. You're paying a higher rate of capital gains tax, in fact, the highest rate for doing that. You can look at any expenses you've put on the property over time to try and mitigate that through time, to look at it increases the book cost, the price you pay for the property. But sometimes it's the right thing to do. you shouldn't let the tax tail wag the dog is a phrase we would talk about. And this is the idea that you need to take a step back, think about your overall plan. Why might you sell the property and why would that be the right thing to do? And then you can work out if it's worth doing that after paying the tax as well. And I think, rightly, understandably, people have an aversion to paying tax they don't need to pay, and holding on to the property or holding on to the investment can feel like it's the right thing to do. But if it's too risky or isn't helping you achieve your goals, and we can talk a bit later on about in the decumulation phase, maybe why properties don't work, you should just bite the bullet and then pay that tax. And then think about the future element from it through time as well. There are schemes you can do to try and sort of defer tax through time, but I think most of those are not the right things to be thinking about. It's take a step back, think about your overall plan. Why would you be selling the property, and does it make sense after the tax from that part? Remembering always, capital gains tax is only something you pay if it's gone up. And if you wait for it to go down and there's no capital gains tax, you're much worse off than if you pay the tax.
Holly, do you have any thoughts about how emotional we are about when to sell our property?
I think that comes through with everything. It does within investments as well. I know in the past I've held on to investments longer than I should because I might have lost money on them. And I think I'll just wait till they come up to what I paid for them. But that's ridiculous because I'm forgetting their opportunity cost. What could I be doing with that money? OK, I might sell it. I might realise a loss of £1,000, £2,000, but I could have put it into something else that had momentum behind it. So I think behavioural finance is really interesting. And I think being really aware of how our emotions play into things, how it we're all fighting against that. And we all hate paying more tax and we think we have to. So I certainly, when I came to sell this rental property, I delayed for a bit. One of the reasons was just I didn't want that capital gains tax bill. But to Matt's point, I had a capital gains tax bill because the property had gone up and I had made some money. And it was the right thing to do. I don't regret selling out of it. It's not an easy path, I would say, for people to choose. And I think we do tend to underestimate the hassle factor of owning a property. If we look at yields you might get at the moment from owning a property buy to let, in London you might be looking at 4 to 5%. In the north of England you might be looking at nearer sort of 7 to 8%, for example. But if you look at the moment at a 1-year fix, for example, on a savings account, that's about 4.5%. So you compare that to what you get from a rental property in London, then you compare the hassle factor of having a rental property with having a cash savings account. And I think progressively, over the last decade, it's become harder and harder to justify having a buy-to-let property.
Moving on to when we're thinking now approaching retirement, and so you have some spare cash, do you think, this is $1 million question, put it into your mortgage, pay off your mortgage, or put it into your pension?
I think at that moment, just pre-retirement is a great time to take a step back and think about what am I trying to achieve and what tax benefits can I get. Often your peak earnings, and so therefore you might really benefit from tax relief from putting money into a pension. And we talk to clients quite a lot at this point that are past 55, so that they no longer have the money locked up. They can take it out again if they need to. And they're likely to perhaps at retirement switch from being a higher rate taxpayer to being in a position where they can control their tax rate a little bit more. So pensions can be really attractive at that moment, because if you can put the money in and get the tax relief that Holly was talking about at 40%, you get 25% out tax free. And then maybe you can draw out the rest of the money at basic rate tax or 20% tax. That can be really attractive. We do, though, hear lots of people that say, I've got a lump sum, I'm going to buy a flat, and that's going to be my retirement, because it goes back to all those emotive elements of feeling comfortable about it. It's safe. I know where it is. And maybe you think you're going to have a bit more time. And we shouldn't underestimate that transition at retirement is a huge thing for people to go through. And maybe focusing on the flat and the dealing with the tenants and so on is something that you want to do. And I do think that people underestimate that emotional change from work to a retirement phase. But most of the people that are a few years later on start to see that as a hassle rather than something they're really enjoying doing, and there are other things they would have rather done with their time. So it's definitely a balancing act. You asked Helena also about whether you put it into your mortgage. I think that's about thinking about your home and what the plan for that is. So for a lot of people now, they plan to sell their home at some point and release some equity. A lot of them would have seen a big increase in the value over time, and they might not need a big family home, for example, at that point. So if you're about to sell the home, then you might think twice about whether you need to pay off the mortgage or whether selling the property is going to do with that. And that's where a bit of longer term planning really helps. So we do a lot of cash flow modelling with clients to look at their investments into the future and look at their property and say, okay, if I want this lifestyle, this level of income, and I want to retire today, what are the things I can do? And maybe paying off the mortgage is something you have to do. It's very hard to refinance your mortgage once you've stopped working because you get less income. Or maybe the plan is to sell the property, release some money, pay off the mortgage and buy another property and be in a strong position. The point of the cash flow modelling is you can see the choices and the trade-offs that you have. Because what that I can't do is tell you the sort of value you put on having that property. Maybe you've got a lovely garden. The plan in retirement is to look after the garden, and that's going to give you loads of value. My spreadsheet or the modelling can't really value that part of it. But the point is, if I can show you 2 or 3 scenarios, you can then take a step back and go, well, this one will work better for me. I'll have more certainty. I'll have more income. Or this one is going to be great. I'm going to keep the house and I'm going to sell it in 10 years' time at that point in time.
I also think there's we're sort of brought up, aren't we, to almost sort of think that all debt is bad and you have to pay debt off as soon as possible. Depends very much on what people are paying, clearly, on their mortgage at the moment. But we are expecting rates to come down gradually. I don't think it will sort of be a massive change. But let's say sort of in 6 months' time, we might see mortgages more typically begin with a 3 than with a 4. Let's say sort of rates are sort of 3.5%, for example, for a mortgage or thereabouts. That's not very expensive debt in the grand scheme of things. So I think of debt a bit like fat. You can have good fats or you can have bad fats. And quite often mortgages, they're the good fats. They're the avocados, if I'm going to torture this analogy, rather than the French fries. So actually, particularly then I think this trade-off happens on the spreadsheet that a higher rate taxpayer is doing, because pensions are much more attractive for higher rate taxpayers. And so you think, okay, I could pay that mortgage off, but if I'm paying 3.5%-4% on my mortgage every year, what's that going to save me? Versus if I put that same amount into a pension. We've talked about working out the tax relief you get back. If you're a higher rate taxpayer, let's say you're in your 50s, for example, it's not a million miles away when you'll be able to get that money out, then pensions start to look really, really appealing, I think.
This is really complex, though, and it is perhaps a time where getting some professional help and advice does help. I think if you're in accumulation, following some of the simple rules of diversification, saving regularly is really going to get you a long way. At this point where you're getting closer to decumulation, when you're about to retire and there's all these trade-offs and choices, we really feel that that's a moment to go and talk to someone to help you think it through. I mean, Holly talked earlier about emotions as well. Even professionals looking at their own money make bad emotional decisions because it's your own money. So having someone else independent that can take a step back and say, this is what you should be thinking about. Did you know about this tax rule or this benefit, can be a really powerful thing. And I think although there'll be a cost to that, benefit can be felt for many years to come.
And at Netwealth, do you find that people find it difficult to identify their goals? Or?
I think they do initially. If I sit down with them and say, what are your goals? People go, I don't know. Yeah, what does that mean? What does it even mean?
Be better.
Yeah,
be less rubbish.
Yeah, exactly. Life goals. But actually, if you start to talk to them about what some of the regular things are, most people have similar goals. And we can then say, well, what do you value more? Is it about the amount of income you have in retirement or when you retire? And some people go, I really just want to retire at 60. That's my goal. And you can say, right, well, this is the trade-off. If you retire at 60 versus 62, it might be £1,000 a month of different income or whatever the numbers are. That's probably a bit much, but the point is that there are trade-offs and you can value those trade-offs. So we can help them through those goals. The other thing is we can challenge some of their goals. They might say, I absolutely have to help my children onto the property ladder. And we say, well, that might be something that's worth doing, but should you be doing it today? Or are you in a position where you're ready to do that for yourself? Is it the right thing to do? Or can we build a plan that factors in giving them some money in maybe 10 years' time if you are going to sell the property again at that moment? Is that when you help out your children? And then you can work through these different parts of it and what the goals are and whether they're achievable or not. But right, to your initial question, do people understand what their goals are on day one? No, probably not. They need that help to tease it out.
Do you think, Holly, we might be too gung-ho as we approach the retirement?
I don't know. I think sometimes people are, when they come up to retirement, we think too cautiously in a way. Now, the world's changed, our life expectancy has sort of changed, we're generally sort of healthier, living longer. I think there's still a sense among some people that when you come to retire and you hit that point, you de-risk, which means you move money from shares into bonds or you move more into cash. But actually, if you're doing that at 60, you might have 40 years left and it's far too early to be doing that. So I think we need to sort of really look at our options at that point of retirement and make a plan that actually factors in more longevity than we might have assumed in the past. So in a way, I'd say now, if we're talking about someone who's 60, I would say this, it's sort of self-serving because it's not as far away as it used to be. It's not that old, right? So I think how we think about retirement and managing our money in retirement has got to change. And there's still, I think, a sense as well from people. I talked at the very beginning about a lack of trust in the financial services industry. I think at that point of retirement, lots of people have this instinct to get their pension out, get it into somewhere where I can control. They remove it from that sort of tax-sheltered world. Mm-hmm. Perhaps pay more tax because they take it all out at a point in time, more tax than they needed to, and then they leave it in cash. But it's sitting there in cash, not doing very much for what could be 40 years. So I think we have to challenge a lot of the perceptions that suddenly when we retire, we get a letter from our pension provider and we think, oh my God, I've got to take my pension out. I can do that now. It's far too early.
And it's back to this question of what is risk. So what are the risks for you at one stage of life might be different to others. So one of those risks for you at that point is longevity. Are you going to have enough risk in your portfolio, enough return to keep up with the fact that you might live a very long life? And then there's the liquidity part. You can deal with these things in different areas. So having some cash at retirement is right. And it's probably a bit more cash than when you were working because you don't have an income coming in from a salary. But it's probably 12 months worth of expenditure. That's what we talk about in terms of cash to hold. It's definitely not your entire pension. Sitting in cash is a good thing to do. So you can be thoughtful about where those risks are and how you mitigate different parts of it. So if you are keeping a buy-to-let property, for example, at this point, then just make sure you've mitigated the risk that has for you. So if it does go void for a month, have you got some cash to one side? If you might have an emergency amount when you need 50,000, where can you get that from? Have you got an ability to access the capital from somewhere else in your wider plan? So it's reassessing what risk is. But no, I think people aren't too gung-ho. They're actually a bit too conservative generally at the point of retirement. And some of that's the industry. We had this sense in the pension world, as you say, they get this letter and says you can buy an annuity or you can take your whole pension. Well, there are other choices than that, but that's maybe the way the industry was set up. And we have funds that are also designed to target annuities, so they naturally move you from equity investments into gilts, essentially, over time. And that's great if you're going to buy an annuity, which are less risky. And the 15-year gilt is sort of how an annuity prices. So it's trying to match that risk up that you want the most you can get from your annuity. But if you don't plan to buy an annuity, which more and more people aren't, then that's not a very good place to be. So it's more about what risk is being mitigated and how.
What about when is it time to think about passing some wealth on and gifting and looking at the next generation? Holly?
This is, of course, a question which is really sort of key in people's minds at the moment because of recent changes to inheritance tax rules and pensions. And so I think a lot of people who had built up their pension thinking they'd be able to pass that on free from inheritance tax are suddenly really having to rethink their whole strategy. Do they draw money now out of their pension? That used to be the last place, effectively, you would go to take any money out because you could pass it on free from inheritance tax. That will all change. So I think, I don't know, Matt, I suspect you're getting more calls now. In fact, probably most of your incoming calls are from people rethinking their pension and what role it plays in light of inheritance tax changes.
Yeah, it's definitely a big factor. So from April 2027, they're going to be subject to IHT. And as you were saying, Holiday, exactly. The strategy for many people was leave the pension. It's like an insurance policy. If I need to dip into it, I can. But why would I pay income tax to take the money out if it can pass to my beneficiaries tax-free? We should remember that for those with larger pensions, there was something called the lifetime allowance that used to take a chunk of that value away from you when you passed away or age 75. That's gone, but it's absolutely something now you have to think about. And so the question is, how do you take the money out of the pension and maybe gift it on through time? To do that, you need to be confident you have enough money for yourself. That's where some of this modelling really comes into play. So we've built a series of tools to let people just have a look at that into the future. Do I feel confident that I can give money away? Because actually giving away, say, 100,000 today is very different than the value it will have in the future, because you're not just giving the money away, you're giving away the growth in that money over time as well. And if you have to pay tax to get it out of your pension, there's an impact on that. But the secondary part of this is to remember that the value of that money to the person you're giving to is probably greater today. We often talk to clients about, is it useful to give your children money when they're in their 50s and 60s, or would it be much more useful to give it to them when they're in their 30s and 40s?
I think they'd have something to say about that,
Yeah. But it chucks out questions around control as well, around it. So you need to have the confidence that you can afford to gift, and then you need to start thinking about how to do that efficiently. So a lot of gifting, of passing money on, happens through something called a potentially exempt transfer. And this is the 7-year rule that's sometimes talked about. The idea is you can give away actually as much money as you like. If you live 7 years, it's outside of your estate for inheritance tax. So that's a really generous thing to do versus some other countries in the world. And so that is a great thing to plan. You can't control that money though. Once you've given that money, it's theirs. And around property, there's one nuance we should just keep in mind. People think about, can I give my house? If you give your house and you still live in it, you need to pay rent. Otherwise, it's called a gift with reservation of benefit. The idea is you haven't really given it away. You're still living in the house. So if you want to live in it, you have to pay a commercial rent for doing that. So it makes it a little bit more complex. But if there are other assets you can give, that's a sensible thing to think about. Around the pensions, now the question is, well, if I have to pay income tax to get the money out of the pension, what I don't want to do is pay 45% income tax as a starting point. So how do you manage the money out of that? And particularly our clients that we've been talking to a lot are those that do have properties and pensions. And they were thinking, well, my property is giving me my income, my pension is going to be for the next generation. That's great. The problem with the property income is it just keeps coming in each time, and it might move you through your tax bands. So if you're going to draw any extra income from the pension, you might be paying higher rates of tax. So something there is to take a step back, think about the plan. If I'm planning to give some money away, well, maybe I don't draw it from the pension. Maybe I sell the property, give away the capital there. Now I will need more income, but that income might come from the pension, and that's what you live from through time. You spend down the pension over time. So you're being more thoughtful about it, how you can draw from those different pots. And that's one of the big pluses of an investment pot. If you have general investment accounts, so taxable investments, ISAs and pensions, you can blend your income more flexibly through time, whereas a property is a sort of unit that will give you a yield, which can be great, but you can't control that, where that income comes from or how you draw it. So that's a big area we've started talking to clients about at the moment. If you do have more income, there is something called gifts out of excess income. These are regular gifts as well. So if you have a lot of property income that you don't need, and so your income exceeds your outgoings, and it needs to be your true income rather than capital expenditure, you can make regular gifts, then those move outside of your estate from inheritance tax straight away. So that can be a really nice thing to do. If you do have either pension income or property income, it could be that you can afford to give away £500 a month, and you do that every year on a regular basis. The other nice thing about that is, back to this control point, you might feel much more relaxed about giving a child £500 a month than you would do handing them 150 grand in one chunk.
I've got teenagers, it's terrifying.
It is, right? And this is this trade-off, isn't it, of tax efficiency, control.
And it's about flexibility, isn't it, as well, Holly, I think.
And I think, we haven't we've touched very briefly on annuities as well. They were sort of out of vogue for a while, but actually they're at, I think I'm right in saying, sort of 15, 16-year highs. So they're suddenly an interesting part of the mix. So I think more and more, we've talked about diversification from a point of view of what shares you might buy or what investments you might buy. There's also diversification of all these different vehicles, which don't have to be mutually exclusive. You can have an annuity, you can have a drawdown pension, you might have a buy-to-let property as well. So I think it is, and I definitely think at this point, at the point of retirement or at the point of planning how you might mitigate inheritance tax, this is a point where I would advocate people get financial advice. I think there are many times in our life where we're saving up money, we might be in our 30s, 40s, 50s, we're relatively straightforward. At that point, I think lots of us can get by on our own if our affairs aren't that complex. But at this point, when you've got all these trade-offs and with policy changes coming thick and fast from a government who has that growth mandate at all costs, I think this is a time where financial advice is really sensible. Matt also mentioned something called cash flow planning, which I went through that exercise with a financial advisor. I saw them as a one-off sort of thing. It wasn't ongoing advice. And it's really interesting. They look at what you spend. They look at all the money you've got coming in. It's quite terrifying. They look at all the money that you spend and categorise it. But they then can tell you, actually, it takes the guesswork out. And I talk to some financial planners who actually, as a result of this, say to people that they can afford to do more or retire earlier or to work less. So it's a really interesting exercise to do. But life's pretty complex at the moment. The tax rules are getting more and more complex. So I do think at that point, financial advice is well worth considering.
It is bewildering, isn't it? I mean, at Netwealth, what do you find are the most common pitfalls that people fall into at this stage?
Yeah, I think a lot of it is the sort of ostrich approach. It's all too much and they just sort of put their head in the sand and they don't think about it at all. And that's very dangerous because those problems build up over time and you miss some of the opportunities. So, we talked about taking money out of pensions. That's the sort of little and often part. And if you leave it too late, it's hard to fix. So we do think you should get advice, and it can be one-off. We offer both one-off advice and ongoing advice for them. The other big pitfalls are around investment pots. We see really regularly the wrong assets in the wrong places. So it might be that the long-term pot is their pension, and that ends up being in cash somehow along the way, which is often a bit strange. And because it's really easy on a DIY platform, an AJ Bell or a Hargreaves Lansdowne or someone like that, to invest through a dealing account, they're doing all their risky trading in the taxable portion of their investments, which is probably where your safe haven is, your cash should be. So those kind of pitfalls are really common in it. And then often it's just misunderstanding of tax elements of it. So getting that help, and it doesn't have to be regular fees on an ongoing basis if you don't want or need that. It really can just help you take a step back, see those sensible things, back to that controlling the controllable parts of it. And then you can have a plan with confidence for the next phase of it and work out how you're going to go through the navigating what should be an enjoyable element of retirement.
Common pitfalls, Holly, is anything that springs to mind in terms of...
I think we tend to make things more complex than they need to be. I talk to a lot of people who manage their own investment portfolios, and they can take diversification to the nth degree. So I talked to someone who ran his own pension account. He wanted to transfer it. He had about 70 funds in there because he was so scared of picking a wrong un that he picked tons and tons and tons. And therefore, if you're picking a lot of different funds that are run in particular styles by people, you're kind of negating out the moves that they're making. You're negating out the sort of bets that they're making inside those funds. So you're paying a lot of money for something you shouldn't be paying a lot of money for. You'd be better off picking one global tracker fund at a low cost and being done with that. So I think trying to make things harder than they need to be is a key risk. And also, we like cash. And so I think actually, oddly, we don't take enough risk. I don't mean by that we should all go out and buy crypto madly tomorrow. What I mean is we've got to be really clear about what is short-term money. And for that, we don't want to take any stock market risk. We might need that money in 3 months' time, in 6 months' time. That is suited to cash. But for anything we're leaving for at least 5 years, certainly anything we're leaving for more than 7 years, we should be investing it in the stock market. And we shouldn't necessarily chicken out and panic if we're given risk profiles to choose from. It's a bit like sort of picking wine. We sort of pick the third sort of cheapest one on the menu. People do that with their investments as well. But I'd say, well, why not take the highest risk? It's not the same as being cavalier. It just means it might go up and down a bit. But if you're in your 30s or your 40s and say this is pension money, you should be taking as much risk as you can. Same if you're investing for children in a junior ISA and they've just been born. That's 18 years that money's going to sit there. So there's no point. And people do this because it's your babies. You want to protect them. You think, I don't want to take any risk. People buy cash junior ISAs. Doesn't make any sense. It's sitting there for 18 years.
That leads us on very nicely to, we've had some questions come in from listeners, and Sarah asks, is now a good time to start investing for the first time, or is it too turbulent?
I think the general adage is today is always the day to invest, because in general markets go up. So, and you can get paralyzed by trying to find the right moment to do it. Very few people buy at the bottom, because at the moment of that real opportunity is when it feels the most difficult time to invest. So you think, well, it could go down again tomorrow. It could be a much worse. COVID was a really good example of this as well, of the mismatch of news flow versus markets. So we saw the financial markets really sold off a lot when COVID came around in March 2020. When we were seeing on the news all the terrible news flow and all the issues that were coming out, and it was getting worse and worse, and there was more lockdowns, the markets had already looked through that and moved forward. But if you're sitting there individually, it doesn't feel like a great time to buy in. So I think if you've got some spare money to save and you've got a long time horizon, and you do it tax efficiently, today is the day to invest every time, and do it little and often, keep doing it, and don't worry too much about whether there's an announcement next week or something else that moves it around. It's about taking the long-term benefit of compounding that up.
And I think that little and often is really important as well. A lot of the DIY investment platforms will allow you, it's quite easy to set up a monthly direct debit. And so that sort of smooths out the price you get into the markets at. So I think little and often, set and forget. Then you don't have to sort of worry about it.
Interestingly, Jessica's come in with a question. It says, is it worth spending less on rent and saving aggressively so that we can buy a home, or live somewhere we want to live now and build savings at a slower pace over time? I mean, that's an impossible question, isn't it, really? But
it really is. But it does get to the crux of the sort of financial versus the emotional and the value to you. So, if you took it to extremes and you're really unhappy because you're trying to save the money to buy a property, that might not be the right thing to do. But saving something does make sense, because in the long run, if you're paying rent, you're giving a return to the landlord. That's that back to their yield and their outcomes. If you're paying money into a mortgage in your own home, then you're investing in your own value over time. So I can see the value of doing it, but it's about finding balance between those two things, and how you do that, and then how you value it. So again, this is where financial planning is more than the numbers on the spreadsheet. If you're having to commute in and that's really tiring and it's really impacting your overall life, it's not the right thing to do. Find the balance along the way, so that you can be making the direction of travel, and also time. Think about the length of time you're doing this for. If you have to save over 5 years, but it's a property decision you're doing for 30, 40, 50 years, that's okay. And it might be about finding that balance in your life and your plans.
So Kay asks, intriguingly, what is the minimum capital needed for a medium risk investor to generate an annual income of £40,000?
Well, I mean, as a rule of thumb, you can, let's say you invest into a UK investment trust. There are plenty of sort of names out there that have paid dividends sort of reliably, increasingly for many, many years. You might be looking at a yield of around about 5%. So Matt, correct me if I'm wrong, but on £40,000 a year, that would mean you'd need a sum of about £800,000 to generate that much income. Again, medium risk, it depends. That is on an assumption that that dividend yield that you're invested largely in shares. But you can invest in some investment trusts that invest in pretty blue chip, sort of reliable mainstream brands.
Yeah, and I think what you need to think about there is it right just to get the yield? If you're saying drawdown in retirement, it's okay to spend some of your capital. So this is back to sort of rules of thumb. We don't want to protect the capital forever. It's natural to spend some of it, but you don't want to spend too much. If you're drawing 10% per annum, the money might run out too fast. But if you're drawing 6 or 7, that's probably okay over a longer time period. And then can you do the sensible things to make that better? Can we try and make sure we pay as little tax on that 40,000 as possible, so the sort of gross amount that's coming out of your investment pot is as minimal as possible to get the net money to you? So there's nuances to how to think about that, and this is actually relevant on how you save as well. So things like putting money into a pension for 2 people in a couple can be really efficient in the long run, because then you can draw it out at lower rates of tax and in the future as well, or blending it with ISAs to get that mix together.
Rupert actually asks, why are stocks and shares and ISAs not taught about in schools? But also, looking at return on investment, to what extent has property become an inferior investment in comparison to stocks and shares in 2025? I think we've covered that a little, but...
I think this comes down to the idea of diversification point, though, right? I can pick you a stocks and shares element you could buy inside an ISA that's done amazingly well, and I can pick you some things that have done very badly, and the same for property as well along the way. And I think, equity market returns have been decent over a long period of time, particularly if you invest in things like the US market, and even on a diversified basis. You don't have to have picked Tesla or an Nvidia or something that's done amazingly well individually. I think the question back to why we don't teach it, I really don't know. I think we're not very good at financial education more generally in teaching people the basics of how money works, what mortgages are, debt, those sorts of things that are real useful life skills. I think everyone should leave school knowing that there is this thing called an ISA, and that you can use it if you need to, and it's tax-free, and it's a sensible starting point. So there are some people that use it that don't need it, because actually they're not going to pay much tax otherwise. But getting in the habit of that's the place where you put your savings and your money is an amazing thing to teach people.
Holly, a question for you. How to balance distributing wealth, including your pension drawdown, to the next generation tax efficiently versus keeping enough in case of care costs? We don't know how long we're going to live, do we?
Yeah, there's lots of unknowns in that. I think care costs, it's one thing that we just don't want to talk about. No one likes thinking about that and planning for it. But it is really expensive. I think we all have to sort of factor it into our plan. I'm sure that's part of the conversation you have with our clients. This is where I would say I'm not sort of avoiding the question, but it is worth talking to a financial advisor, even for a sort of one-off session, and talking these things through to make sure you factored everything in. It is that sort of unanswerable question almost, isn't it? Is at what pace can we draw down our money without running out of it, whilst also managing inheritance tax, which is getting ever more complex. So it's that balancing act, isn't it, of how much to gift and when versus how much to leave in reserve for care costs, which can be, hundreds of thousands of pounds.
Yeah, and have you made sensible assumptions? So care costs are definitely high. What we sometimes see is people overestimate how long they might spend in care. On average, people only spend 36 months to a couple of years in a care home at that point. So absolutely it's high. And you might still have your property. So that might be how you deal with the plan that says, well, we'll have to sell the property to fund the care home costs. Around inheritance tax, again, how do you think about the plan? It might be in the early stages where you've got a lot less certainty about how much money you're going to need, that you buy life insurance to protect against that potential liability. And if you're young, a term life policy, if you're in your 60s and you buy a 15-year term life policy on joint life second death, this is the idea that it's when the second person in a marriage passes away, which is when the inheritance tax would be due, that's quite cheap. And that might help you mitigate that risk. And then in 15 years' time, you might feel much more confident about how much money you need. Perhaps you've had many more years of retirement. You've had more investment returns to look at. So you can factor these elements in, but they are unanswerable. Like, one thing we say often is we show you the path of return and the average one. The one thing I can tell you won't happen is exactly the average return. It's about the ranges around that and having flexibility. So coming back and checking in again in a few years' time, back to the little and often. If you're going to give money, give some money now, hold a bit back, give some more money in the future. The second plus of that is you get to see how they behave with it. If you're worried about control, and you can decide if that money's now going to charity or somewhere else over time. So, I think it's just about being sensible with the assumptions you make and the plan you put in place.
A question from Shadan. With growing uncertainty in both property and equity markets, how should young professionals in their 20s and 30s approach long-term wealth planning? What proportion of their portfolio should be allocated beyond property? And how do you see tools such as that of Netwealth shaping those decisions?
So, I think the tools that we have help you see the long-term benefit of compounding. So we have some wealth planning tools, for example, where you can see the benefit of tax relief on a pension contribution compounded over time. The thing I'd say about uncertainty is I think it always feels an uncertain time for investing. The news flow's always there. There's geopolitical risks, there's inflation, there's interest rates. But you need to take a step back and say that over time, generally, markets go up. And that's what, if you're young, that's what you're backing. You're not trying to get it right in today's investment versus tomorrow's investment or the next one. You're taking a view that I've got 30, 40 years and markets will generally go up and I'll get the benefit of that. The tools help you see some of the trade-offs. So it might be you're trying to work out whether you take a slightly bigger mortgage and put some of your more money into your pension each time, and you can start to see the difference of that in a compounded impact over time, because it's hard to see what the difference of putting 5% extra in your pension is today for your retirement in 40 years. That's where technology and some of the things that we've built can help you do that.
I'd also say if you're in your 20s and 30s and from the sounds of it a relatively sort of high earner, one of the first things you should do is check out your workplace pension. Particularly larger firms may contribute extra. They may do what's called matching. So if you put in an extra 2% into your pension, they might match that and do that too. If they do that, and you think about the power of compounding, that's going to be in a pension growing over time. For many, many people, I'd suggest that is the first port of call, because if your employer will match extra pension contributions, that is money for jam. And so particularly sort of people in their 20s and 30s, because they have the power of compounding on their side.
Got time on their side.
Yeah, lucky thing.
So there's a few questions about getting started in property investment. Kimberly asks, how do you get started in property investment if you don't have much capital?
I mean, that's a tough one because property isn't cheap, it isn't liquid, all of these things. I mean, one option for people who want to invest somehow in property, you can access that via the stock market. There are things called real estate investment trusts, REITs, which you can buy, which give you access via the stock market to a collection of sort of properties under the bonnet. But I think in general, for people that don't have much capital, property is a difficult place to start. And if you are going to buy those REITs I mentioned, I mean, they should be 5%, 10% of your portfolio tops, I'd suggest.
Final question from Geeta, who says, I'm very new to stocks and shares. How does one invest with medium risk?
Well, if you're very new to this, there are things out there called robo-advisors. I've always thought that's a dreadful name. But what it is, it's like the Blue Peter sort of, here's one I made earlier. So, Geeta, if you don't know sort of what you're doing and she wants to set this up, you can find a robo-advisor. Boring Money reviews them on our website. You can say, I'm a medium risk investor, and it will pre-assemble something for you and do it all for you. So it really is quite easy to get started. You don't have to know what you're doing. You don't have to feel like the expert. And there are some really credible options out there.
Yeah, I think going back to something Holly said earlier, though, check if you should be a medium risk investor. So if we think about risk is ability, willingness and need. And often people end up going, I'll go in the middle. That feels safe. That's the sensible thing to do. But if you've got a really long time horizon and you don't need to access this money, then maybe you can afford to take a bit more risk for some of that as well along the way. So still using those sort of pre-packaged funds or platforms that can help you do that. That can be a great way to get started if you have no idea where to start. But yeah, challenge your assumption that you're a medium risk investor.
On that note, I'd like to say thank you both to Holly and Matt. You've certainly given us food for thought for our investment. And it's made me realise how important it is to set goals and have a sense of where you're going and when. What would you say would be, if you were imparting your pearls of wisdom, what each of you, perhaps you could give us your main takeaway from people today?
I'd say don't procrastinate. Too many people sit on the sidelines waiting till they feel they've got the perfect strategy. There'll never be a time when you have that. So I'd say just start and be aware of tax. We've talked about that a lot today. We can all get obsessed about potential returns, or if I buy this, it might go up by. Actually, a lot of that will be negated if you're not in the right tax efficient vehicle. So I'd say more and more these days, we have to be really smart about tax and make sure we understand the allowances available to us and take advantage of those.
I think for me, get some help from people. As in, you don't have to do this all by yourself. That might be going somewhere like borrowing money and getting help with picking the right place, looking at the comparisons. That might be talking to an advisor, getting some support around the tax planning, and just be thoughtful about how someone else can help you get started with this process. The final bit, just to link to that, is make sure you don't pay too much for that help along the way. Think about fees. They make a big difference over time, but you can find people that will do that in a cost-effective way, and the value will definitely be worth paying for.
Well, it's been a delight to bring you this conversation, and there'll be more from the Telegraph Media Group and Netwealth later in the year. Thank you.
Thank you.